All right, so when you're ready, let's get underway.
Okay, let's go.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Dylan Grice. He's a partner at Calderwood Capital. You've been reading Dylan's work for more than a decade. I've loved it. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Dylan. How you doing?
Hi, Toby. I'm good, thanks.
Tell me a little bit about Calderwood Capital.
Calderwood Capital is, I suppose, it's quite an unusual startup because that's what it is. It's an unusual business because we are a research business, and we're also an asset management business. So we are aiming to launch our first hedge fund in May of this year. So we are kind of going through the final stages of that, and which includes kind of test marketing and stuff. We are hoping that will be. We'll bootstrap it with our own capital, and then some capital of friends and family, and just kind of get the thing on the road. And I think next year we'll aim to get some traction with that. We'll then roll that out and try and raise money from from a wider circle. But the research, I suppose, there's nothing unusual about that. I suppose what's unusual is that the kind of nature of the business. As I said, I think it's quite common for kind of hedge funds and asset managers to publish research and give that research away for free. We're actually not doing that. Our research is a standalone business.
And that's the Popular Delusions?
That's Popular Delusions. Which is what I used to write when I was at SocGen. It was the title of what I used to write at SocGen. But I think that that was obviously some time ago now, and the world has changed. I've changed, so it's more of an evolution, I think.
Let me give everybody some more background. So everybody will remember James Montier wrote Popular Delusions at SocGen, left for GMO. And I think
he wrote Mind Matters.
I'm sorry.
He was big into obviously behavioural finance, and so his kind of research area was Mind Matters. So
I'm sorry, I didn't realise that. I didn't realise that was.
He'll kill me if I don't put that in.
I read his stuff when he was at Dresdner Kleinwort, and because he wrote this great little review of the little book that beats the market called The Little Note That Beats the Market, and he pointed out in that it was the value factor that drove all of the returns and not the quality factor that drove the returns, which I found fascinating. And then when he left, so I started reading Popular Delusions. It was one of the most fascinating reads at the time. It was so hard to get your hands on a copy of it, and I finally reached out to you, and you very kindly put me on your own private distribution list. So I loved reading it, and then you sort of disappeared for a while, and I thought of you about a year ago, and I thought, I wonder where Dylan is, and I reached out to you through LinkedIn, and then you popped up on Real Vision as well, and so I just wondered, what have you been doing in the interim?
Well, it's a good question. I think I had a great time at SocGen, a really fantastic time. I know banking is a kind of funny business and it gets a bad press, and I understand why. I spent enough time in banks in my time, but SocGen was different. It was a really kind of unusual place. They really allowed us to breathe, and they allowed Albert and me to a lot of creative license, and it worked for them as well. We were successful for them. So it was a brilliant kind of phase, but it was ultimately it was just writing. It was writing and it was commentating, and it was just words, more words, and there wasn't really any action. There was no acting there's no doing anything, there's
right.
no decision making. It was just writing, and there's nothing wrong with that at all, by the way. But it's not really me. I think I've been a prop trader for 5 years before I took over from James and teamed up with Albert. I think words without action is kind of like sex without love. You do need the two things to kind of to feel more kind of whole. And after that kind of period at Soc Gen, I was really I was becoming very frustrated with not actually doing anything other than commentating. And so I kind of took the plunge and ended up in a slight detour, but I came to Switzerland, where I still am, and I was hired by a family office. So family offices are obviously typically quite secretive. This was a Swiss family office, so it was like kind of
doubly secretive,
squared.
Right.
So they kind of didn't want any. They didn't want any profile at all, which is actually fine with me. I kind of wanted. They wanted me to build a business. They wanted me to build initially an equity business, but it then became the whole kind of liquid allocation, and that's exactly what I wanted to do. And I didn't really want to be kind of doing that in the public gaze or in the public glare. So it was almost like the complete opposite of Soc Gen, where I was talking a lot but not doing anything. When I was at Calibrium, I was doing an awful lot without really talking much about it. So, I mean, to kind of bring it back to where you started with Calderwood Capital, Calderwood Capital, the research business and the hedge fund, it's actually kind of hybrid of both. It's much more about getting my own particular balance right. So I still get to write, but I actually get to build a portfolio as well.
What's the what's the strategy at Calderwood? What's the hedge fund strategy?
So we're actually, I can't believe I'm saying this. Actually, it's been a very kind of strange route to here, but we are setting up a fund of funds, multi-strat, multi-manager fund of funds. So the reason I kind of, a part of me kind of, I still kind of double take who the hell does fund of funds these days?
That's a very contrarian play.
Well, it's been a very interesting time. It was a very interesting experience in the family office, and I learned a number of things. I learned that allocation asset allocation is much more kind of in keeping with my own kind of investing personality. One of the kind of I did feel slightly uncomfortable, as a commentator, especially a macro commentator, because macro commentators know everything. They know exactly what Trump means when he tweets this, or they know exactly what the Chinese are going to do, in response. And, they know someone who knows someone who, has got the inside line on Iran. And so there's lots of people who just know everything. And I kind of always felt that I don't really know anything. I certainly don't know very much. And so there was always a very kind of defensive kind of foundation, a defensive kind of philosophical aspect to my own thinking. And I found that kind of really expressed itself, I think, very powerfully in a fund of funds, when you can really go literally wherever you want. If you're an equity manager, then you're an equity. That's fine, right? And you use the different types of equities, but you're kind of you're in a straitjacket when you're allocating. You have and I spend a lot of time thinking about how to hedge tails and how to hedge market events. And actually, if you've got proper diversification, you don't need any of that. It's a free hedge. It's free, and you can only really express that type of ignorance, if you like, building a portfolio which is robust to ignorance. You can only do that if you're willing to kind of explore radically different risk premia, income streams, cash, whatever you want to call them, return streams.
So you won't have any tail hedging or any crisis alpha in the portfolio?
the mandate will be as wide as possible. So you never say never, but generally speaking, no. I think if you can get some cheap convexity in the portfolio, it's just a phenomenally valuable thing if you think about it, because you've got insurance. What you want is to insure your portfolio against really, really bad stuff happening. And typically you have to pay for that. You don't get free house insurance. You don't get free life insurance. You don't get free market insurance. So is it worth paying that? And typically, I think the answer is no. I think the far better approach is to say, well, okay, why don't we just say equity risk? Yes, we want equity risk in the portfolio, and yes, equity risk is a valuable premium to harvest over the years, but no, equity risk is not going to dominate the entire portfolio. There's a whole bunch of other things that we can do. And if they're truly uncorrelated, then, if the world goes to hell in a handbasket, yes, your equity risk is going to blow up, but, maybe your kind of longevity risk is going to offset, or maybe your catastrophe risk is going to offset that, So, I said, the real kind of, the holy grail of portfolio robustness becomes much more alive when you can actually allocate to different managers. So that was the starting point, really, for the idea. The other thing was that I just felt, and trying to kind of build the team at Calibrium, something we really struggled to find was good fund analysts. It was really, really impossible. And we kind of, I kind of had this kind of epiphany, this light bulb moment, which was that people who love investing, they want to be the guy leading the venture, right? Or they want to be the guy, actually kind of picking up the pieces in a court case and doing the kind of distressed investment, or they want to be the one with the macro call betting against some country's exchange rate. They want to be that, on the front line pulling the trigger. They don't want to be a fund analyst. They don't. Who the hell wants to do that? It's almost like choosing quite. It's there's not a huge amount of competition, right? So that's just another aspect to it.
So it's global macro, but it's executed through a fund of funds, so that the guys who are the guys who are making the investment decisions at the pointy end are running their own businesses. So it's sort of distributed global macro, something like that.
I would, I mean, I wouldn't call it global
decentralized.
It's very much kind of decentralized. I think, macro allocation is a kind of branch of macro, but I call it a know-nothing macro. It's a kind of macro for dumb people. That's kind of what it is. I found it was just much more in keeping with my own kind of philosophical bent. I guess the other thing I discovered at Calibrium, the obvious headwind with hedge funds, alternative managers, is the fees. But I kind of realized that this kind of move to low fees, as an absolute priority, I think that it's actually not. It doesn't really work like that. It's not. Yes, all else equal, you want lower fees, but frankly, there is such a thing as getting value for fees, right? And it's not the same. Low fees are not always. It doesn't mean that you're not always getting value for your low fees. In the way that you're not always getting value when you buy a cheap stock. You might still be overpaying. My partner is ex-Rentec, actually. He used to run Jim Simon's London office, and the medallion fund charged, I think it was 5 and 45, and
still outperformed.
Well, he still generated a net return of nearly 40%. So people care about net return. If you're allowed to invest in a fund that gives you a net return of 40%, you wouldn't really care that you're paying 5 and 45 as fees. So if you turn that down because the fees are too high, frankly, you're an idiot. So I think that this was also a kind of realization. I think the fund of funds model very, very discredited because I think it's typically not done properly. And this could be famous last words, but our kind of our intention is actually to do it properly.
Well, how do you do it properly?
As I said, you have to be very willing to embrace very unusual line items, right? So a fund of, if you look at a fund of funds and you've got say 60% equities or 50% equities and 30% hedge funds and kind of maybe 20% bonds, and your hedge funds are basically long short equities and credit funds, then you basically have an equity portfolio, right? That's what it is. Now, even if you outright forget the long only equities, suppose you actually say we'll have long short equities, we'll have long short credit, we'll have long short equity, we'll have some macro, and we'll have some CTAs. What you basically got is an equity portfolio, right? Because long short equity is just equity. Long short credit is, very, very kind of, you're taking on a lot of recession risk. CTAs should be a diversifier, but what typically happens, certainly the month that any kind of crash happens, your CTAs get wiped out as well because they're on the wrong side of the trend, almost inevitably. And macro also, macro is a slightly different thing, but all too often you find that macro managers they're basically long carry, and that as a strategy gets hot when it's a risk-off environment. So you end up with a portfolio which goes up when it's risk on and goes down when it's risk off. And why didn't you just have an equity portfolio? What's the value you really added with that particular allocation? And I think that's one reason why it doesn't work. Get comfortable with just very, very unusual line items.
It's been a challenging period, I think, for asset allocation in particular, because there's so little yield in bonds, and where they're traditionally viewed as a safe haven asset that should sort of go up a little bit when equity indices collapse. They're sort of to that point where they're very, very sensitive. So a lot of guys have been looking at the yield in debt and say, or particularly in like US treasuries, for example, and saying that's a bad place to be. But it's been one of the best trades over the last 5 years, even though it's been a common refrain. So what do you do when the potentially one of the sources of hedge in the book is going to trade probably more like equity?
Well, again, it depends on how. Well, it's actually, I'm not sure. There's a lot in that. I think to kind of work backwards, there is still a case for the kind of diversification benefits of government bonds, even in this kind of crappy yield, because it's not about. And again, I think this is a mistake that people make when they're talking about portfolio construction. You typically want highest return stuff in your portfolio, right? And obviously, when something is returning basically 0 or 1 or 2%, it's difficult to see why you would have that in your portfolio. It's such there's no juice left in this anymore. Why would we want it? There's just a lot of downside and not a lot of upside. I understand. But I think it's not the right way to look at it. The right way from a portfolio construction is, what does it bring to the portfolio? Right? Is the portfolio better with this or without it? And the fact is that a portfolio which has that genuine kind of rally into risk off, which you only get with, and I hate this phrase, risk free, but you only get it with risk free duration. That typically improves a portfolio even with virtually zero yield. If you actually kind of run simulations, kind of a mean variance kind of optimizer, and you ask it how much government bonds it wants, the answer will always be non-zero because of this kind of diversification benefit. So even at these crappy yields, there is it's not as dumb as it sounds to include them in a portfolio. We wouldn't have any in our portfolio, by the way. We wouldn't have any bond managers in our portfolio because we think we can do far better than that, right? But I think some people are not willing to kind of explore, very kind of weird asset managers. Some people are not very willing to, I think, take the time to understand complex strategies, for very, very good reasons. if you grow up with a complex strategy, you're sitting in a pension fund, you've allocated to some kind of credit manager, they don't really understand what he's doing, but his returns are good for the last 3 years, so he sounds very clever, so I'll allocate to him, and then before you know it, he's down 70%. You get fired. You get fired for that. There's not really any upside to you allocating to someone like that any more than there's any upside. When was it Peter Lynch when he wrote One Up on Wall Street? He said, you never get fired for owning an IBM, right? If you own some kind of small cap, micro cap stock that dumps 50% one day, they don't ask what's wrong with the stock, they ask what's wrong with you. Why don't you just own IBM? And I think an allocation is kind of similar. You don't get fired for allocating to Bevan Howard, right? But the real kind of juice is actually in these kind of, I think when you go more off the run. So if people aren't willing to go off the run, and maybe if they're not willing to do that work, if they're not willing to get comfortable with sometimes incredibly esoteric opportunities, then I think that your default vanilla position of government bonds, and I would mix that with some gold, it's not as dumb as it sounds.
That's a good segue into a discussion on your philosophy. I've read you sent me through the updated Popular Delusions, and I sense that your philosophy is sort of an Austrian economics approach to it. It's been a rough decade for folks who've got a hard money Austrian view of the world. Why do you think that is, and do you think that's going to change? Do you think that Austrian economics has a place in the investment world?
I mean, it's such a great question. So yes, I do love Austrian economics. I actually slightly have an issue with the adjective, right? For me, it's just economics. That's actually, economics took a very strange turn. Maybe I think
Keynes?
It started. Not Keynes wasn't that new. I think really. I think that you saw in France, you saw this credit bubble, this kind of hyperinflation during the Mississippi bubble, and it was John Law, who was a Scotsman, and he had this idea that you could increase activity by increasing the money supply, and therefore the only way you could do that was with paper money, that would be elastic, and so this kind of paper money craze was born. So a lot of John Law's stuff was very Keynesian. So it wasn't. I don't think Keynes was necessarily. Keynes had a lot of absolutely brilliant ideas. In my opinion, also some really dumb ones. But I'm not a Keynes hater at all. I just feel that I think it was with Samuelson. I think the economists, the kind of Charlie Munger talked about economists as having physics envy, and they really wished that it was physics. And I actually believe I'm quite passionate about the idea that economics is a science, right? It's fundamentally scientific. It's fundamentally about trying to find the order and the chaos. And I just feel that economists are really not very good scientists. And this whole kind of physics envy thing is really just a reflection of how bad they are as scientists. I think the Austrian guys are far more kind of epistemologically honest about what they know, what they don't know, and some of what the Austrians were able to deduce without modern computers or the ability to write algorithms and run simulations and see how an economy might look on the different assumptions. These guys really kind of pioneered chaos theory, for example. They pioneered the notion of a self-organizing system, right? Before it started to crop up. And the idea of complexity, before people started to really understand what complexity was, the Austrians had already figured out that that's what an economy was. Sorry, my voice is getting a bit croaky here. Hayek was talking about the information content of pricing, right? He was really talking about information theory, right, and money as a channel, right. And von Mises was talking about economic calculation. These guys were talking about the economy as a computation machine, right? These guys were kind of absolute pioneers long before Shannon had written his book on information theory, and long before complexity was a branch of mathematics. These guys were already talking about it. So it's a long-winded answer, but yes, I really do feel that for some reason it's seen as this loony fringe movement, and I think if you read it, these guys are absolutely right. Of course they're right. So on that side, that's easy. How do you make money out of it? How do you invest with it? So I think that's a totally different thing. And I think that one of the problems you get with a lot of Austrians is that they have a very clear idea about how the economy should be and how the world should be. And investing is not like that. Investing is about the way the world is. And so Austrians always want to buy gold. They're always bullish of gold. You know, they were bullish of gold in the 80s, you know, when you entered into a 20-year bear market. And the bear market was just around the corner. How many Austrians sold, right, in 2014? By the way, I didn't. You know, I'm not kind of pointing the finger. What I did do was reflect on why I didn't. But, you know, I think that Austrian economics, I'm not really sure it necessarily goes with investing. Because the world is the way it is, not the way you want it to be.
That's a nice segue into one of the articles that I liked in your more recent Popular Delusions was discussing the anatomy of a forecast error. Can you perhaps describe for folks what that article was about and what the conclusion that we can draw from it is?
Well, where to start? You know, I had been, you go back 10 years when I was at SocGen, and, you know, like a lot of people, I was I really didn't like QE, hated QE, and didn't really like the precedent that it had set. And I kind of felt that this was going to end badly, right? This was a mistake, and that they shouldn't be doing it. I really hated QE, and I also really don't, you know, I really hated it. Hate is a strong word, but yeah, I kind of don't really like economists at all. You know, as you probably gathered already. So really not a fan of the discipline. As I said, I think they're very poor scientists. So you've got these kind of economists who are running around. To my way of thinking at the time, actually still, by the way, but these guys had just blown up the financial system, right? These guys, the whole thing was largely caused by their incompetence and them really not knowing what they were doing. You know, Ben Bernanke very famously in 2006 said that there was no housing bubble. He even went further and said it couldn't be a housing bubble because, you know, house prices had never fallen. It never happened before, therefore it could never happen. So this is just like kind of, you know, logical error. We've been 101, right? Just such a stupid thing. And I just couldn't really believe that these guys got away with it, you know. I think, so the latest thing was QE, and I hated it. And I also, you know, one of my kind of little kind of hobbies is financial history. And I really kind of, I love financial history. I do know something about hyperinflations and bubbles and stuff like that. And I kind of just joined the two things together and said, you know, this is how hyperinflation starts. Now, I did explore hyperinflations, historic hyperinflations, and how they work. And I kind of came to the conclusion that, you know, it was very unlikely we were going to see any kind of hyperinflation. Although I thought that the main candidate, I think actually later somewhere that I thought that the near-term candidate was Venezuela. But the one that bothered me the most was Japan. You know, they're completely kind of monetizing their debt. But I kind of felt it doesn't have to be hyperinflation, you know, for this to be an inflation problem. Right. And what's going to happen? You know, like for example, the 70s was an inflation problem, right? It wasn't hyperinflation, but you know, you get double-digit inflation. it affected the investment landscape meaningfully. So I kind of thought that this was where we were going, and I kind of said it was actually 2010. In 10 years' time, we will see the white of inflation's eyes, right? We will see a nascent inflation problem. So this was a very kind of firm prediction that I made. Within 10 years, we would see an inflation problem. And here we are 10 years later, and I think that 30-year break-even inflation rates are like 50 basis points below where when I made my prediction. So, I guess that just set off a kind of, and also just kind of speaking to some friends of mine who agreed with me and also thought that inflation was clearly going to be the next big issue. So I said, well, what did I get wrong? Why did I get that one so wrong? And so that piece was really just me trying to kind of unpick where I went wrong. And I think that the main area I went wrong is, this is something that a lot of people do. But I guess there were three things really. One, I just fell in love with the idea. I fell in love with the theory, right? I really enjoyed learning about hyperinflation. I really enjoyed seeing and the closer I looked, the more obvious the parallels became. And I just enjoyed that process, right? So I liked my own theory, right? I think in academia they have this. I think they have some phrase for it. It's something like theories are kind of like toothbrushes. You've got to have your own one, right? And everyone only uses their own one, and everyone loves their own one. So I kind of fell into that trap, kind of without realising it. Another trap I fell into was that, and this was a big one, and this is something that I'm much more wary of today. But I really felt that I would write, Ben Bernanke's a clown, the Fed are clowns, these guys are this and all they're doing, and this just really kind of struck a chord, right? And people just love this, especially coming from quite a big kind of investment bank, So it suddenly kind of went. At the time, I think it was quite a kind of unusual thing for a bank to say, and so it kind of went viral, and I got a following, and so I had a following of people who loved to hear me tell this stuff. And before I knew it, I didn't realise this until years later, but I was actually playing to the crowd. Right. And I started, and again, this is why, without mentioning any names, but, I've seen it, you've seen it. Investors, when they go public with a thesis, it's a disaster, right? Keep it to yourself. Shut up, right? Because, it just becomes so much more difficult to change your view when you've got a bunch of followers who are only following you because of that view. And I think actually a really kind of interesting stroke tough example of this was a friend of mine, Hugh Hendry, who called the 2008 crash, right. Made a lot of money out of it, and did really, really well for his investors, and was seen as the bearish guy. He was seen, and he was all over TV. He was all over Bloomberg. He was on very high-profile news shows in the UK. And some of the footage of those shows went kind of viral because he was lambasting.
It was great. It's cathartic.
It was wonderful. He was like, finally, someone with a brain is on our side, and he's actually calling out these frauds for what they are. And so far so good. But he was now seen as that bearish guy. When he turned bullish,
right,
a few years later, all his investors deserted him, and they said, "Well, what's the point in you?
You were our hedge.
You were our portfolio hedge. If you're going to be so." This is the danger. You have to be very careful what kind of followers you get, right? If you get followers who follow you because of this particular view, then that impairs your ability to update your view as kind of facts come in. And I think that if you're investing, you try and get the world right, then it's really just a continuous process of updating, and you're not really doing yourself any favors. This was another thing that happened to me. the main one that I really should have seen, because I see it often in other arguments, I see it in other discourse, and I find it very low quality. It's very famous low quality tool of arguing, which is ad hominem, right? Forget the argument, just attack the person, right? And you see it, when you do see it, you just kind of think, did you just do that? Did you really? Oh, that's a terrible thing. You just lost the argument. You're attacking the person. Donald Trump does it all the time, right? So I think it's just a very low quality thing to do. And again, I didn't realise it at the time, but I was doing that. And in particular, I was allowing my dislike of economists, and particularly guys like Larry Summers, Paul Krugman, all these kind of, I just think they're phonies. I don't really think they know as much as they say they do. But these guys were all worried about deflation. So I just kind of thought, well, if Paul Krugman's worried about deflation, then obviously I'm going to worry about inflation, right? Which, again, it gets a few laughs from your audience, but that's no way to update you. That's not an argument. That's just dumb. So this was another mistake that I made. They were the main categories of errors.
It was a very honest assessment, because I think you could have said, well, inflation isn't counted properly by CPI statistics. It's probably understated. Hedonic adjustments are sort of nonsense. And then you could have also said, well, there's that Austrian view that inflation doesn't necessarily run through the CPI. It could run through asset prices. There's a pretty strong argument that we've seen some pretty material inflation in asset prices.
That's true. That's absolutely true. I really do believe that, and I think that you can even measure it, right? I think you can kind of measure just to what extent asset prices are overly inflated. So in terms of whether or not CPI is correctly measured with a hedonic adjustment, maybe there's some truth to that, but I'm not so sure on that argument. I've seen estimates. I can't remember the guy's name. He said that inflation actually runs at 10%.
That's the shadow stats. John Williams, I think.
Yeah, I just have difficulty believing that actually the economy is contracted by, because if inflation has been 10%, then I think that real GDP growth must have been kind of minus, 5 or 6 or something. That's not what I see. So that's just a question mark. I don't know the right way to measure it. But the point is, inflation is an estimate. It's ultimately a judgment, right? It's not actually measurable. And when you try and build in asset prices and equity prices, you just find that there's this whole kind of worms. Conceptually, it's not measurable. And this is the Austrian perspective. It's dumb. It's absolutely dumb to even try and measure something like something as complex as a kind of artificial monetary disturbance, because there's always prices going up and prices going down in different parts of the economy. But an economy-wide increase in prices it's very, any increase in the money supply will trigger some kind of change in relative prices somewhere, because it must do as soon as people start spending that money supply increase. Therefore, that's inflation. Now, whether it shows up in the CPI or somewhere, we don't really know, right? That's the kind of Austrian perspective, and that's the whole folly of central banks targeting this made-up number in the first place. It's just bloody stupid, right? But that's what they do. And to go back to your point, yes, I could have said all of those things, and I believe them, but that wasn't my prediction. My prediction was we were going to see CPI inflation, right? We were going to see it within 10 years. So, there's no point in trying to wriggle out of it, because you could also say, well, it just hasn't happened yet. But that's not a forecast. If you say what's the weather going to be like tomorrow, you say tomorrow, right? You're specifying a time. A forecast has to have some kind of time dimension. You can't just keep saying, I'm just waiting for it to happen. I'm definitely right. It's just my timing's wrong. It's going to happen tomorrow. It's going to happen the day after. So I don't think that you should wriggle out of things that way either. My forecast was very, very specific. It was about CPI inflation, and it was within 10 years. And I think I even said it would be more than 4%. So wrong on all three counts. And I think It's very. I think it was a very constructive thing for me personally to kind of rub my own nose in that and say, right, what did I get wrong, and how can I not do that one again?
I think there's been a lot of introspecting by Austrian economists and value investors, particularly over the last decade or so.
Yeah.
One of the interesting things I watched, MIT had this billion price project. Did you ever follow that, where they had this idea that they'd track all of these different prices through the economy, and that would create this CPI. When that first launched, it seemed to be tracking well above official numbers. And MIT's take on that was, well, our calculation must be wrong. We'll go back in and we'll make some changes to that. And I was reminded of it as I was reading you've got that great story about Richard Feynman, and then updating I think, was it Planck's constant? One of the, in your popular delusions? Am I getting the wrong?
Yeah, that's right. It wasn't Planck's constant. I think it was something to do with when they were measuring the charge of an electron, and the original guy who did the experiment, I forget his name now, he was a Nobel Prize winner. And he kind of got it basically right, but not quite right. And it's because the way he measured this charge, he'd used some kind of apparatus. I think he'd used some oil, and he hadn't quite got the viscosity of the oil right, and that was slightly biasing his results. And then what happened over the next kind of 20 years was that when physicists tried to replicate his measurement, they were coming up with a different answer. So they'd find a way to lower it so that it was like his original answer. And this kept happening until someone realized the mistake. No one actually wanted to stand up and say, no, I think that's wrong. Why is that wrong? Let's get to the bottom of it.
So Richard Feynman there's another great experiment in there where somebody this is something I follow pretty closely, the replication crisis. I'm kind of interested in it because there's so many things that have been, particularly in psychological studies and social science, many things, but also in medical, in medicine and various other things like that. There've been these findings that they were unable to replicate, and Feynman makes the great point that there may be an incentive not to get those replications. Not to try and replicate it at all, but then he says if you're going to conduct an experiment where you're changing some part of the experiment, you need to first of all replicate the original experiment, and then under your own conditions with your own apparatus, then go and change it.
Right. Absolutely correct.
Yeah, it's just the experiment you included that in one of the popular delusions. Is a great discussion on it. I don't know if you can remember the story.
Yeah, you just said it. These are the basics of obviously Feynman was Nobel Prize winning physicist, and his love was physics, and his passion was physics, and his criticism. This was a 1974 speech he gave at Caltech, and he was actually criticizing the kind of academic establishment for not being diligent enough with replicating other people's work. And he gave a couple of examples. I think there was an astrophysicist. I think there was someone else who was working on a kind of atom collider. In each case, when that person had basically asked to replicate the work that they were hoping to build on, they were told not to waste the time. They don't have the budget. They don't have the resources. We don't. Just it's fine the way it is. You just go on and do what you were going to do. So there was this pressure. There is this pressure. Feynman was talking about this pressure that academic institutions are under to find something new, to generate new conclusions, new results, to find new science, right? And he then, in the same speech, talked about the same kind of thing happening in psychology, and he basically gave a warning. He called it cargo cult science. The cargo cults were the kind of the Pacific Islanders who'd never really, and I believe that it's actually just a standard kind of phenomenon that anthropologists talk about, and it's reasonably well documented. Is when you have a low-tech society comes into contact with a high-tech society, and then, the high-tech society then disappears. So think kind of, New World explorers, for example. I think some kind of British explorers in the kind of 17th, 18th century documented the same kind of phenomenon. But the one that Feynman talked about was the Pacific Islanders during the Second World War. When the Americans had come, they'd used the island as a landing base, and they'd kind of dropped their cargo, the planes would kind of land. They made a runway. The Americans made a runway, and the planes would land, take off again. And then the war finished, and they didn't need this kind of supply depot anymore, and so they packed the bags and went home. And the cargo cult locals they built a new runway, right? And they built a runway to make it look like the old one, and they built a control tower to look like the old one, and they built a controller to a kind of almost like a kind of scarecrow that looked like the controller that actually had kind of bamboo shoot headphones, right, and a bamboo shoot microphone. And so everything was replicated to look just like the setup that the Americans had put down. Because the idea was, if we can make it look like what the Americans did, we'll get the cargo, right? We'll get the good stuff. And Richard Feynman was saying, if you make your science look like science, you'll get the same result that the cargo cult guys got, which is nothing. Right. Just because it looks like the thing doesn't mean it is the thing. And effectively, he was, his warning, which went unheeded, was, I think, what is now known as the replication crisis, because people are not doing science, they're not doing honest inquiry, they're trying to find something new for the sake of it, because the pressure that academic institutions are under to find something new is exactly the same kind of pressure, and this is why I find it very interesting, exactly the same kind of pressure that financial players are under, right, to launch a fund and to demonstrate why this is such a brilliant idea, right, to launch an ETF and to demonstrate why this is because look, we've done the back test, we've done the science, we've actually we brought in some academics from some Ivy League university, and they're now an advisor to our board. So we're putting the science into finance, right? And we've launched an ETF each year. But no one's actually asking, well, is this science any better? Is this real science? Is it real financial science, or is it cargo cult science? And I think that, in my view, it's cargo cult science. A lot of these, kind of factor ETFs, a lot of these risk premium ETFs. They're really, it's amazing how many of them are no longer working. They've gone live. They look great in the back test. They look wonderful in the back test. But a lot of these factors, a lot of these risk premia, they're just not there. They're not there when you actually try and test them in the real world. And the answer, I think, is because this wasn't science. This was cargo cult science.
Last question, and then I'll let you go. But it's sort of a bigger one. And it was actually my first question, but it's taken us this long to get there. You talked about a golden age in duration, a bull market in duration, and you think that might be coming to an end, and then you've got some predictions for that. So what was the golden age in duration, and what are the implications if that goes away?
Well, so we had a very inflationary economy in the 1970s, and that was a global phenomenon, it was a widespread phenomenon. And what happened was, as we know, in the 80s, 90s, noughties, and over the last 10 years, the inflation kept continuously surprising on the downside. And what that did was it drove bonds to much higher levels, bond yields to lower levels, bond prices to much higher. And obviously, the longer the duration in the government bond, the better the return. One of the kind of interesting things to me that I discovered, which I wasn't fully aware of, during this period, if you go back, if you use the Schiller data for the returns, and by the way, this isn't, you would need to do more work to make sure that this is actually the right message. I only looked at the US market, that's where I had the data. But if you go to the equity risk premium, if you like, so the excess return of equities over bonds, it's something from the 1870s to the present day. It's something like 4.8 4.3 or something, 4.4%. That's been your excess return for holding equities over bonds, right?
Right.
Since the 1980s, that risk premium has actually been about 3.6. So the equity risk premium has actually been quite low, right, during this period. The excess return of equities has been quite modest, right, during this period. The real action has been in the bond market. The returns of bonds have just been absolutely flat. And of course, that carries everything with it, right? Because equities are a duration asset, right? It's actually permanent duration, infinite duration, but they're duration assets, right? If bond yields go up, your NPV comes down, right? So, when bond yields go up, then capitalizations will fall, as they kind of must do. So this NPV uplift that you got into equities from bonds was certainly very, very pronounced. But the real bull market in equities since the 80s, to my mind, was actually a bull market in bonds, and they're a bull market in duration. And therefore, what you've seen over the last 40 years, 80s, 90s, noughties and tens, you've seen this bull market in all duration assets, whether it's public equities, whether it's private equity, venture equity, government bonds, corporate bonds. All of these things have just been, you've just been in a phenomenal period of returns for these asset classes, and it's all been driven by government bonds. And you don't need to predict a massive inflation problem to see that, the likelihood of it's very difficult to see how that happens again. How do you get the same tailwind when bond yields go from 20 to 2 over 40 years, right? How do you get that kind of structural tailwind for duration assets? And the answer is you don't. So you don't get any tailwind. Best case scenario, I think, you get no tailwind. Worst case scenario, that turns into a headwind. Right. Because actually you do see a pickup in inflation, you do see a pickup in bond yield, and everything goes into reverse. But the basic idea was that, as pension funds are all falling over themselves to allocate more to private equity and to venture, I think it's over. That game's over. That whole thing is over. So I think the whole duration bull market is over. Equities, bonds, corporate bonds, private equity, it's dead. There are not going to be any returns doing that. For the next 40 years, what's going to work is things that didn't really work so well in the last 40 years.
What's that? Commodities?
That's going to be our new fund.
That's great. I was going to see if I could pin you down for a prediction. I'll get you back on in 10 years' time, and we can analyze that one.
No, we'll kind of see. I do feel that I keep saying it. Unusual line items. There are. You don't have to be. It's not all about cyclical risk. It's not all about macroeconomic risk, right? It's not all about equity risk. There are other risk premium you can take. Now, if you've got a 30 billion endowment, okay, then that's a difficult one. That's a very difficult problem to solve. I'm not sure there's that much you can do. But if you can be small and nimble, I just think as I said, this is why we set up the business. It's just it's an incredibly exciting time to be an investor at the moment, I think.
I think that's a great note to leave it on. Dylan, if folks want to get in contact with you, what's the best way to go about doing that?
Well, I'm kind of on, I guess, Twitter. I'm kind of new to Twitter, actually. I only really started kind of using it a few months ago. But I think it's just a brilliant.
We'll blow you up a little bit on Twitter then with this one.
So Twitter's good. I take direct messages. LinkedIn is good as well, though I have to say I don't use it that much, but I do check it every few days, so it will find me if you send me something on LinkedIn. If you track down my popular news on Calderwood Capital website, we have a couple of sample issues of a research, and my email address is all over that. So you can go and have a look at some of the stuff we've been talking about and read that, and maybe it will be interesting to you. Maybe it will just go straight into your trash.
What's your Twitter handle?
Dylan Grice.
I'll link that in the show notes if folks want to get in contact with that. Dylan, thanks so much for your time. Any parting words?
No, this is actually my first ever podcast. So I kind of I feel it went quite well. Did it go quite well? Did you?
That was great.
Yeah.
Usually I tell folks after I sign off, but you did really well.
This is a milestone.
I'm very happy to have done that. Dylan Grice of Calderwood Capital, thank you very much.
Thanks a lot.